Hello, Andrew here, welcome to my channel on investing. Target date funds, or also called life cycle funds, are very popular among investors. The assets under management for these funds stood at $3.5 trillion at the end of 2023. But what are they and why are they so popular among investors? And are they really that one-size-fits-all type of answer to all investors' needs? These are the questions I will tackle in this video. Let's dive in. Target date funds are mutual funds. They provide a diversified exposure to stocks and bonds with changing allocations. As the target date approaches, the fund will reallocate money from stocks to bonds. Let's use an example of Vanguard funds. Funds from other institutions such as Fidelity or T. Rowe Price will be somewhat similar. The newest Vanguard fund has a target date of 2070. It is suitable for anyone born between 2003 and 2007. So this fund works for someone who recently graduated from a college and began his or her working career. This fund has 90% allocation to equities and 10% to bonds. We can see that the fund does not directly invest in securities. Instead, it holds other family funds of the same institution. This is typical. Also notice how the fund invests in foreign stocks and bonds. We will come back to that a little later. The justification behind higher allocation to equities for someone who is young is widely recognized. Historical data tells us that the stocks, they tend to appreciate more compared to bonds. They also tend to be riskier compared to bonds. So for someone who is young, stocks and growth should be a priority, hence the allocation to bonds should be relatively small. As years go by, the same fund would gradually change its asset allocations. At some point, it will hold the majority of its assets in bonds. For instance, consider an extreme example of a Vanguard Target Retirement Income Fund. The fund has 30-70% split between stocks and bonds. As you see, this fund does not have any target dates. Eventually, all target date funds will converge on this 30-70% allocation portfolio. And the reasoning is very similar. As you approach your retirement, you want to avoid losses and preserve your capital. Hence, allocating money away from stocks into bonds would make sense under this scenario. Here's the so-called glide path for allocations between stocks and bonds from Vanguard. We see that the typical Vanguard target date fund starts with 90% allocation to equities. This lasts for about 20 years during someone's early career. Then the fund starts de-risking by shifting into bonds in the next 32 years as retirement is getting near. After that, the allocation of 30-70% stays constant during the withdrawal period. Other financial institutions offer very similar target date mutual funds. Vanguard holds the highest share of target date funds assets with roughly 37% market share. The reason Vanguard holds the crown is because of its incredibly low expense ratio. It stands at 0.08%. Most other funds charge around 0.6 to 0.7%. Be aware that the target date funds, they can be either passive index funds or actively managed. To my best of knowledge, the Vanguard target date funds, they all passively managed. But other organizations such as PIMCO or T. Rowe Price, they have their own selection of both active and passive target date funds. The first target date funds appeared in 1990s and they became one of the default options in pension plans, especially after the enactment of the Pension Protection Act of 2006. You can buy target date funds in 401k plans or individual retirement accounts. Also, they can be available in taxable accounts. It all depends on your broker, so you may or may not be able to buy them there. Target date funds are popular for a reason. First, they allow investors to be truly hands-off when it comes to investing decisions. Of course, there are people who like to find and search for a best ETF or mutual fund to maximize their returns. But there is a very large group of people who lack this financial knowledge or even desire to spend hours and hours on this research. The second benefit of target date funds is that they reduce risk. Such de-risking happens gradually over time by reallocating funds from stocks to bonds. And all this rebalancing work is done automatically behind the scenes. You don't have to give it a second thought or effort. And this is probably the most difficult part from a psychological point of view. When someone sees the stock market growing or tanking, making decisions becomes hard. With target date funds, you give up this control. In exchange, you get a predictable schedule of reallocations and rebalancing as needed. Interestingly, there was research done on target date funds. Parker and Son, in their 2023 paper, looked into their contrarian actions. They found that the target date funds behave like contrarian investors. When stocks grow relative to bonds, they will sell stocks and buy more bonds and vice versa. For instance, in March of 2020, during COVID-19, the stock market tanked. As a result, there was a significant stock buying activity by target date funds at that time. This likely helps their long-term performance. Conversely, many individual investors would have been scared to buy stocks then. The third reason behind their popularity is this. They provide sound investment advice at a reasonably low cost. Of course, these funds are not for everyone. If, let's say, I have a knowledge of investing, then perhaps achieving better returns is doable. But what if I don't have knowledge of investing and I still want to make prudent investment decisions given my age? Then the target date funds are the way to go. True, decades ago or so, these target date funds were expensive. They charged high fees. But now with Vanguard, which charges 0.08% fee, it's quite low and likely we'll see other rounds of expense cuts given the competitive pressures. Other benefit of target date funds is that they can offer a wide variety of strategies. While Vanguard pursues a passive index strategy for their target date funds, it doesn't have to be so. Many other organizations offer active or a blend of active and passive strategies. Also, the exposures to equities during the life cycle can vary depending on the fund. All this gives plenty of options for investors. With that being said, there are disadvantages to the target date funds. Here are a few. The first and biggest disadvantage of these funds is that they are not customizable to one's needs. Remember that glide path I showed you earlier? It is the same regardless of my personal situation. Let's say that I'm planning to continue working in retirement. Doing so, I can afford to have a somewhat higher allocation to equities than what the target date funds offer. But of course, there is nothing I can do. In other words, I give up control over changing allocation and risk profile of my investments. Second, target date funds may underperform. There was a research note by Morningstar that I linked here. They compared target date funds with balanced funds managed by Fidelity and Vanguard. If you do not know what a balanced fund is, here's what to know. Those funds invest in a mix of stocks and bonds. Stocks usually account somewhere between 50 and 70%, while the rest is in bonds. Unlike target date funds, balanced funds keep allocations constant. Morningstar found that the target date funds underperformed balanced funds. The underperformance gap was sometimes over 1% on an annual basis. That's a lot. The reason was somewhat peculiar. It turns out that balanced funds do not invest or invest very little in foreign stocks. Conversely, many target date funds have a sizable allocation to foreign stocks. It can be 30% to 40%. You may know that in the past decade or so, US stocks outperformed foreign stocks for many reasons. Also, US dollar appreciation relative to many currencies didn't help that either. This caused better performance for balanced funds compared to target date funds. If foreign stocks continue underperforming US equities, then this performance gap will likely persist. I will have another video where I will compare balanced funds with target date funds shortly. Stay tuned for that. The third thing to watch out for is that not all funds are created equal. For instance, take expense ratios. With Vanguard aside, many other target date funds can be quite expensive. What's more, these funds, they may have different glide path that I showed you earlier. They may have different equity allocations at the initial stages, and they may also have different points in time when they start changing drastically their allocations. True, the target date funds provide the set it and forget it type of approach. Still, they may require some looking into, and this is especially true if your pension provider allows you to invest into target date funds from different providers. And the fourth, and maybe less important caveat, is that most target date funds are funds of funds, meaning they don't invest in individual stocks or bonds. Moreover, these other funds are typically from the same company. For instance, take Vanguard target date funds. Their underlying holdings are other Vanguard funds, as we saw. The disadvantage of this approach is this: rarely the same fund management firm offers the best funds across different asset categories. So it is possible that you may not be getting the best deal. But what's the alternative? Assembling your portfolio on your own? This may or may not work for everyone. Also, investing in the same family funds allows the likes of Vanguard to keep fees low. With that said, target date funds can be an excellent proposition for many investors. They provide fantastic diversification and automatic rebalancing and reallocations for the long term. And this is something that some of us may prefer. That is it for this video, guys. In my next video, as I mentioned, I will compare balanced funds with target date funds and see which one is better. If you learned something new today and you enjoyed this video, please give this video a like. Also, share it and subscribe to my channel for more content on investing and personal finance. Thank you for watching.